Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today, we are going to be analyzing General Dynamics Corp. This one came in by request down in the comments of one of my other videos. If you have a request, put it down in the comments. I'll get it on the chalkboard behind me, which is filling up fast, but that's okay because I'm going to start putting out some extra videos here soon. And then I'll eventually make a video, and I'll comment back to you as soon as I get it written on the board. I usually go over it every couple days or so. Excuse me. As always, this is not individual investing advice. This is just how I analyze stocks. I do have weekly picks over on Patreon at the $25 per month tier level. I also have a free tier over on Patreon where I post all of the same videos that I post here. I'm going to start adding some bonus videos over there probably. And I also, if you want to join the full Cyclical Investors Club service over on Seeking Alpha, I have that link down in the description. I've been running that service since 2019. We're now in our, sixth or seventh year? I don't know, man. I'm getting old. And I'll say this is just, the market is starting to kind of fall quite a bit here in a very bear market-ish type of way. Last week, I put out a video about how much cash I thought, just kind of a generic amount that's kind of reasonable to hold right now. I'm going to give a little pitch for the full Cyclical Investors Club service here. This is the time that if you're ever thinking about joining that you want to join. When I go back to the 2020 crash in March, we had a lot of cash. I bought 30 stocks during that decline that month. And it happened just lightning fast. Now, I don't think the next kind of decline is going to happen as fast. It's certainly probably not bounce back as fast unless there's some major changes that happen. But it can. And what happened that time was I did, really well. We did fantastic in 2020, didn't draw down very much, and then did really good on the stocks that we did buy. I think I've had since then, we're close to 40 doubles or better, like 100%. And most of, like half of those came in that first year. So did really well. But what happened was, it was after that people wanted to join, the Cyclical Investors Club. Well, that very quick opportunity didn't last very long. And then when it was in 2021, the market was really expensive again and pretty hard to find, stuff to buy. So, and then usually what happens is people kind of get impatient because I'm the type of person that I like to get things when they're pretty cheap. And then, they leave just in time for the next crash to happen. I do have a lot of people that come back, because they know that it's a good place to go because you can see in real time basically what's becoming a buy from somebody who hasn't been telling you to buy everything every single day for the past 4 years or whatever. So that's my little pitch for that. Just ahead of time, so I don't feel too bad if the same thing kind of happens again. Okay, because you have to have a cash at the beginning in order to buy things. That's what my video last week was kind of just generally telling people. That's also nice because usually your portfolio doesn't fall as much if you're holding some cash in it. But you have to know what stocks to buy, when to buy them, have some confidence that eventually they're high quality enough they'll come back. And that's where having that real-time access really helps. Okay, General Dynamics, defense company. Now, if you guys watched my video yesterday, I lightened up on my Lockheed Martin. Basically anything that does contracts with the government. I'm not going to really talk about that much in this video. This is just going to be a straight-up valuation video. But that's kind of we'll zoom in here real quick. You can just actually see it. I mean, you can see what's happened since October, like late October, the election basically, down about 20% already, while earnings are rising. So we know it's not earnings related necessarily, like immediate earnings. It's people looking forward and getting jittery about the future. But let's look at the valuation. When we go, one thing to look at is the overall earnings growth is in the right direction, up and to the right. If we just look at the quick view on fast graphs, this includes anticipating a couple years in the future, but like 8% earnings growth and we'll call it roughly a 3% inflation environment. It's not too bad, right? Quality company. One thing and earnings have been pretty steady. We don't have any giant drawdowns. However, what we do see right away is during the Great Recession, even though earnings didn't fall a ton, the stock fell 60% in like a matter of months, it looks like. August to March. Yeah, 6 months, 6 or 7 months, down 60%. And it's not like it was like a quick overreaction. It took a long time for it to recover that old high. Let's say about right there. So how long's that? 5 or 6 years just to get back to even if you're holding it going into the downturn. So it's good to kind of know, history never exactly repeats, but if you go back and look, you can get an idea of what's possible. What's the market done with this stock in the past, especially since the earnings look pretty steady. In 2018, we see a same thing, right? So also not so different of environment. If you remember exactly at this peak, that's when the first tariffs from the Trump administration went on. Not necessarily exactly why that was the cause of this, but because the whole industrial kind of economy it wasn't officially a recession, but it was going into recession by the end of the year. That's why the Fed lowered rates, right, at the end of 2018. That's not controversial. But we can see that this drawdown going into March 2020, when you draw it from the peak, take a look at what it is. If I can get that cursor, there we go. So that's a 50% drawdown there. We should expect this stock to fall at least 50% in a recession. Now, another thing I like to look at is what was the peak PE before it went into recession? And you compare that from period to period to see if the drawdowns might be similar. So the peak PE here was like 16, maybe it's a little higher back here. Yeah, we'll call it 18 and a half. This one looks like it was more expensive, right? And it was. The peak PE was more like 22. So that might explain why, even though this was just like not even a real recession, because it bounced back so fast, why the stock fell almost the same amount from 2018 to 2020 as it did back in 2008 when there actually was like a recession. So the valuation going in is important, can be important. I mean, sometimes the market just does its own thing, but that's worth going up here and seeing what it is, see how it compares, right? So 23. So this is much more like the 2018 valuation. And that means what was this one? 18. I mean, that's significantly more expensive. So instead of falling 60 or 65%, it could be a 70, 75% drawdown from the peak if you have a similar like Great Recession kind of scenario. In terms of sentiment, it's mostly sentiment, but they're anticipating all these flat earnings, right? That's some of what happened here because the stock didn't just immediately jump back up there. It just kind of stayed down for a long time, right? Okay, so that's just some general context here, and then we'll get into the math. Okay, so what I want to know is how long it would take me if I bought General Dynamics to earn my money back just from their earnings. If I bought the stock here. So the way I like to think about it is if I paid $100 for the business, how long would it take that company to earn $100 in earnings? And that's what I'm going to calculate here. And that can give us a good idea of what the valuation is. All right. If we just look at the basic fast graph, the earnings growth rate is 5%. That's pretty low. That measures from this point here to this end of this year's earnings. They've bought back actually some stock during this time. They bought back 18%. Okay. So I adjust for that as well. And when I do that, I get closer to a 3% earnings growth rate during this time. I do that because when they reduce their shares, that inflates the earnings per share growth. And the fast graph is using earnings per share. So I just try to adjust for that. So when we look at that, we're getting 3% earnings growth over the 10 years in a 3% inflation environment. So it's been a no growth business in my view for a decade. Now, that doesn't mean that that's going to continue being a no growth business for the next decade, but I like to use that as my baseline. So I'm going to use I think it's 3.05% earnings growth rate when I do my calculations. And then on just, its face, If you think they're only going to earn 3% growth, or maybe 4%, depending if you think they're only going to earn the inflation rate, an 18 PE is very high to pay. And so that's one of the reasons why the market freaks out whenever there's any kind of problems, and it'll trade down to like a 9 PE. That's 50% lower if the earnings don't go down, right? So you can see that's one of the reasons why the market probably gets jittery. It probably honestly deserves to trade at like a 9 or 10 PE if there's no real earnings growth. It's just a bet on inflation kind of, and defense spending, which is now in question. All right. So, but that's the setup. We're going to base it on this past 10 years and see what happens. So we need to know the earnings growth rate, which I just talked about, and then we need to know the earnings yield. On the fast graph here, they have the earnings per share yield at 5.47%, but they also have about 17% debt. That's about 16 or 17. That's the difference of the market cap and the total enterprise value here. I'm only going to include that in my valuation. So we're going to buy the company, we're going to buy the debt, we're going to see how long it takes the earnings to pay us back for that. All right, so get into the spreadsheet here. Okay, general dynamics. Yeah, so my earnings yield is about 5%. So that's like a 20 PE, basically, the equivalent of a 20 PE. So the way to think about this is if you buy the company for $100, you would earn $5.03 that first year plus 3.05% earnings growth on top of that, and then we'll collect that money and then we'll add or calculate in another 3% growth for the next years. So the first year you would earn $5.18 on your $100. The next year you'd earn $5.34, then $5.50. We want to know how long it would take to add up to $100 doing that. And it would take about 16 years if we assume a 3.05% earnings growth rate. This is a little more expensive than the market. Average market price has been 15 year. It's been about 15-year time until payback. I like to buy stocks when they're closer to like a 10-year, unless it's a growth company. I might be willing to extend that a little longer. I would say the only reason this probably isn't a 15, and the S&P 500 has been falling, obviously, so maybe it's down to like 14 now. I don't know, but it's right in 14, 15 range still. Probably the market's expecting more earnings growth. Yeah, so if I put 5% earnings growth instead of 3%, that gives us a 14-year time until payback, right in line with the S&P 500. So to me, a person might look at it and maybe think it looks reasonably priced or cheap relative to the market. To me, it looks like it's priced just the same as the market. And then you add on. Now, also for me, this earnings growth is too slow. One of the reasons I buy stocks is because I don't want to have to calculate the inflation rate. I want to know that no matter what inflation is, they can pass that on to their customers. And these guys probably may be able to do that. Well, they have been able to do it historically and over the past 10 years, but they haven't grown other than that. So I want some growth on top of that if I'm going to pay an 18 PE, right? So for me, generally, I want stocks that I consider the mark of quality to be growth, because all the stocks are trading at multiples that are higher than 8, right? Now, there might be some point where a stock trades cheap enough where it does they do trade at 8 PE. We saw it. They almost traded at 8 PE back in 2020. But if that happens, usually there's higher quality stocks in the market that you can buy that are growing. So for me to get enticed into kind of a no growth business, they would have to be at a good valuation when there aren't alternatives that are growing, right? That are similar valuations once you include that earnings growth. So I don't know what the stock has done performance-wise since then. Let's see if you pick the bottom here, how you do. Up 121%. I mean, that's not bad, but to put this in perspective, I bought Tractor Supply, I bought AutoZone on this one of these. Their date was a little different than theirs. That's February 28th, and I bought those 3 weeks later. But this also bottomed earlier, and they're up over 300%, right? Berkshire Hathaway was purchased almost this exact same time in the Cyclical Investors Club, and it's up almost 200%, right? And so you think, what do you want to own, General Dynamics or Berkshire Hathaway when you're in this situation? To me, the answer is pretty straightforward. You want to own the Berkshire Hathaways. You want to own the companies that are growing. And then not only will you do better, but you won't have to worry so much about these declines when they come along that are 50, 60%, right? And then usually what happens is you'll get worried and you'll sell at some point because you're just getting creamed. And, that's not the situation that you want to have. So General Dynamics, for me, it's just kind of an avoid. It's okay. I don't have anything like bad to say about it. I do think that the broader forecast probably isn't very good. I mean, if you're doing business with a government. So, but even without that, I haven't had a buy price on this one for quite a while now. Okay, if you found this analysis useful, hit the like and subscribe button. Let me know if you have a request down in the comments, and I'll see everybody later.